Every time a crisis shakes the world, people say the same thing. No one saw this coming. But the truth is, we always see it coming. The warnings are everywhere in rising debt, inflated markets, desperate consumers, and governments pretending everything is fine. We ignore every flashing red light, right up until the moment the crash becomes impossible to deny. And by then, it's already too late. The strange part is, this pattern isn't new. It's not even modern. It's older than stock markets, older than banks, older than money as we know it. Humans have a long, painful history of walking straight into disasters we could have avoided. And the economy is the clearest example of this self-destructive habit. But there's a reason we keep repeating it, a reason we tune out the warnings, silence the skeptics, and chase comfort instead of correction. And understanding that reason might be the only way to avoid what is coming next. If you look back at almost any crisis, 1929, 1973, 2008, you'll find something interesting. Before each collapse, there's always a period of overwhelming confidence, not cautious optimism, but blind belief that nothing could possibly go wrong. In 1929, people said the market would rise forever. In 2007, they said housing prices could never fall. And today, with record debt, an overstretched global supply chain, fragile consumers, and asset prices floating far above reality, people still say, it'll be fine. That phrase, it'll be fine, has destroyed more wealth than any recession in history. The warnings were loud, long before each crisis. In the 1920s, farmers were drowning in debt, banks were overloaded with risky loans, and wages couldn't keep up with the cost of living. People knew it, talked about it, complained about it. But the belief that this time is different was stronger than common sense. Then came the crash, and that illusion evaporated almost overnight. The same thing happened leading up to 2008. People bought homes they couldn't afford. Banks approved loans they knew were dangerous. Entire neighborhoods were built on credit, not cash, and anyone who questioned it was dismissed as negative or dramatic. But when reality finally arrived, it didn't knock, kicked the door in. Here's the uncomfortable truth. People don't ignore warnings because they're stupid. They ignore them because the alternative is too painful to think about. It's easier to believe a bubble will keep inflating, because stopping means sacrificing. It means admitting we're overextended, overspending, overconfident, and operating on hope instead of fundamentals. And people don't want to hear that. People want growth. They want comfort. They want the illusion of prosperity, even if it's built on sand. History teaches lessons, but only to those willing to learn. Everyone else repeats it, and we're repeating it right now. Look around. Household debt is at record highs. National debt has exploded 2 levels, once considered impossible. Many people are one emergency away from disaster. Corporations cut long-term stability in favor of short-term profit. Governments print money like it's free, because facing the real problem is politically impossible. The warning signs aren't subtle. They're screaming, batas always. The majority tries to rationalize them. They say, well, the stock market is still up, or unemployment is low, or things always work out in the end. The same lines were repeated before every collapse in modern history. There's a phenomenon psychologists call normalcy bias, the belief that things will always function the way they normally do. It's a comforting lie. It shields us from fear, but it also blinds us. Normalcy bias is why people stood on the beach during a tsunami. It's why investors bought tech stocks with no profits in 1999. It's why families signed mortgages they could never repay in 2006. And it's why millions of people today assume the economy can truly break, because it hasn't broken for them yet. But ignoring risks doesn't eliminate them. It magnifies them. Right now, the global economy is built on 3 pillars, and all 3 are cracking at the same time. 1. Debt. Consumers are drowning in it. Governments are addicted to it. Corporations weaponize it. Debt isn't the bandage anymore, it's the bloodstream of the system, and when something becomes this essential, removing it becomes impossible. 2. Inflated assets. People are paying 2 or 3 times the value of a home because the alternative waiting feels like falling behind. Stocks are priced for perfection, even as profits shrink and risks rise. The more the foundation weakens, the higher people stack the tower. 3. A fragile consumer. This is the most dangerous part, because when regular people run out of money, the entire economy stops breathing, and millions are already suffocating quietly, pretending everything is fine while paying bills with credit cards and hoping next month will feel different. It won't. Not until the system resets, and resets are never painless. But here's the twist. If the warnings are so obvious, why do we still refuse to change? Why do we keep repeating the same cycle of denial, crisis, collapse, and regret? Because somewhere deep inside, we believe the crash won't hit us. It'll hit someone else. Some other family, some other investor, some other country. We underestimate risk because we overestimate our ability to dodge it. For example, in 1929, most people didn't see themselves as gamblers, but they were all in on a system they believed could never fail. And when it fell apart, it didn't just affect bankers or investors, it crushed factory workers, farmers, grandmothers, children. The same thing happened in 2008. People thought it was a housing crisis, but it wasn't. It was a confidence crisis. And confidence is the only thing keeping the modern financial system alive. Once confidence breaks, everything breaks. What's happening today isn't new, it's familiar. Painfully familiar. People are stretching themselves thin, believing the system will hold. Corporations are cutting corners, trying to squeeze out short-term gains. Governments are printing, borrowing, and hoping inflation doesn't wake up again. And many people feel something is wrong, but they're scared to say it out loud, because saying it makes it real. Maybe that's why older generations speak so differently about money. Those who lived through the Great Depression never forgot the lessons. They saved, they repaired things, they avoided debt. They valued security over status, because once you've seen how fast prosperity can vanish, you never trust it blindly again. Today, most people haven't lived through a true economic collapse. Not a downturn, in actual collapse. And that lack of experience creates a dangerous confidence. But here's the good news. Awareness is the first step toward resilience. Once you understand why people ignore warning signs and how easy it is to fall into that trap, you can break the cycle. You can prepare logically instead of emotionally. You can base decisions on fundamentals instead of hope. You can position yourself to survive what others are pretending won't happen. And maybe that's the biggest lesson history offers. Crises destroy everyone, only the unprepared. Those who listen, adapt, simplify, reduce debt, build cash reserves, diversify, and stay alert. They aren't destroyed by chaos. They navigate it. The warnings are here again. Loud, clear, and impossible to ignore. But the choice to act or pretend not to see them is yours. So as you move through this year, ask yourself a simple question. Are you repeating history or learning from it? And if you found this breakdown helpful, feel free to stick around for more discussions like this. Your perspective matters, and your voice helps shape the future of this community.